deals with long-term investments, and mainly we're going to be looking at investments in another company, not tangible assets like investments in land or something, but more of stock ownership, and then looking at it maybe not so much from the ownership, but also of long-term investments, meaning you buy other people's bonds and you will receive revenue over time for that. So let's jump right in. We've got, if you own stock, accounting has divided it up into 3 areas depending on how much stock you own. If you own less than 20%, it's been determined that you probably don't have much control in the company that you own. Most people, when they buy a stock, own less than 20%, except if you are a really big player in that company. If you think of companies, say they have a subsidiary, that means they own basically that entire company, or they own a very large portion of it, and they can control it. So a lot of big companies have a lot smaller subsidiaries that they, in a sense, they own as well, even though they may not own 100% of it. So the first kind here is the less than 20% stock ownership. And then the next type that we'll look at in the second example is the 20 to 50% ownership. So you have definitely opportunities there for some significant control. So you're going to report to your investment differently since you have that kind of control. Remember, in accounting, we want to be as transparent to anybody looking at our books as absolutely possible. So if you own some of the company, we're going to record it differently than if you own just a little bit of it. And then the last piece that we aren't going to really discuss in this class, it is covered a little bit in the book, is, well, what if you own at least half of the company? And that's when you consolidate. That gets into a little bit more in depth, and we're not going to hit that here. You hit that more in intermediate accounting for those that are going on. And then as you're holding your stock, usually you'll classify it as one of 3 items. Trading is, it's available. You may be selling it within the next couple of days. You may not sell it for the next couple of months, but you're constantly in the market to buy and sell. Available for sale means, yeah, it's out there. I don't have any intention on selling it right now, but if need be, I could do it. There's really not much of maybe a penalty. But I don't have much plans to do that right now. Held to maturity basically means I plan on keeping it for quite a while until it comes due, or a lot of times these are bonds that have a due date on them, and if you sell them early, you might be penalized. Okay, let's look at the back up here. We're going to look at how do we account for items that have or for stock ownership where you have 20% or less, you have less than 20% ownership. The first thing is this is going to be considered, we're looking at this as available for sale. Because in this chapter, we're going to be looking at long-term investments. So things that we don't plan on selling it in the near future. We plan on holding it, but if need be, we could sell it. With owning less than 20%, you're going to make your initial purchase, and you're going to record it at cost. And going back to, say, week 2, if you would have bought a piece of equipment, you would have debited your equipment account, or land if you bought land, and those are long-term assets. Same thing here. We're going to debit a long-term asset, and we're going to simply title it investment, and then using the acronym here for available for sale securities. So these are the available for sale items, and securities is another name for stocks. So investment basically in stock. If you, a lot of times stocks will pay dividends. If you own less than 20%, any dividends you receive, you just go ahead and count it as revenue and debit the cash that comes in. So you're going to record that just like you would normally your normal sales or service revenue. Same format. And then what's different about this, what's different about stocks, and then in relation to equipment you might own or land or a building, stocks are revalued at the end of every reporting period, however often your reporting periods might be, quarterly usually, and then for sure yearly. And what they're going to revalue these stocks, see what they're worth out on the stock market exchange, and we're going to make an adjustment to this account here called allowance to adjust investment in available for sale securities. It's a really long name. It works in a similar fashion to, say, equipment, and how equipment and accumulated depreciation go together. How one account may be 150 and then accumulated depreciation goes right along with it, 151. Even though accumulated depreciation is a contra account, this one may or may not be. It just depends on if the value of the stock goes up or down. So it's not necessarily a contra account. It's not going to be a negative necessarily. It might be if the stock went down. But those two are going to go together. We're going to have the original price, say a $20,000 stock investment, and then if the stock went down to only being worth $19,000, we would show a negative balance in our allowance account here. And then where we're going to credit that, or at least the corresponding account doesn't necessarily have to be a credit, it could be a debit if it's a loss, is to this unrealized gain or unrealized loss. And there's a big difference between realized gain and unrealized gains or losses. Realized gain means you actually occurred the gain. You made a sale and you brought in money and you got rid of whatever it was you had, and you actually did have a gain or loss. This one is there really wasn't anything material that transpired. This is just, what if I sold it? I would have had this, an unrealized gain or an unrealized loss. And being that you didn't actually go through with it, these aren't even reported in the income statement. These are reported below the income statement in an item called other comprehensive income, which is kind of part of the owner's equity, but it is reported as other comprehensive income. And then when you actually do get around to selling your stock, then you do record it as a realized gain or loss and record it on the income statement, because it actually did happen. You did have a gain or a loss. And you're going to base that, the key part here, you're going to base that gain or loss on the actual cost, not how much you had in the allowance account. That account is unaffected because you're going to reverse. You're going to reverse your unrealized gain or loss and that corresponding allowance account. That's going to go away. So by the time you record your gain or loss, the only thing you have left is the actual cost of your stock investment. So let's look at this with an example. Okay, so I bought two types of stock to start out the year. 1,000 shares of Toyota for $50 a share. So when you just do the simple multiplication, 50,000. 500 shares of Ford for $35 each, 17.5. So total, I bought 67,500 in stock as an investment. We come along at the end of the half year. Some dividends are paid. Pretty common. Dividends might be paid twice a year, or maybe once a year. There's no set formula. Toyota, they say they're going to pay 15 cents for every share you own. So if I own 1,000 shares, they're going to pay me 150 bucks, and Ford's going to pay me 50 bucks. So I'm going to need to look at that. Let's stop here and go ahead and look at the two journal entries that go along with this. So I purchased stock worth $67.5. Remember back up here, I said whenever we purchase something and it's less than 20% ownership, I'm going to use the account investment in AFSS. Same thing as like equipment or land. This is just for stock. So here's my debit into that long-term asset account for the $67.5 that I purchased it for, and assume that I paid cash for this investment for $67.5. Now for the dividends, this is actual money I received, and it's considered revenue. if I own less than 20%. And if I only purchased 1,000 shares, that's very little. 500 shares, that's very little. This would be a definite under 20%. So down here, when I show that I'm getting $200 in dividends, that's what I need to show. I got cash of $200, and I have my dividend revenue account, just as I would have sales revenue, and it's reported in the same place on the income statement. Now, depending on how big a difference your dividends are, you might report it as other revenues and not up in your normal high up on the revenue in the income statement. You may report it further down as other revenues, but that's going to be that's for another discussion. Now let's look at so we've done the dividends. Now we're ready for the year-end adjustment time. At the year-end, we look at Toyota, and they are now selling at $52 a share. So it's went up a little bit. So 52 times the 1,000 I have, that's $52,000 of basically what it's valued at. On the other hand, Ford went down, and it went down $6 a share, down to 29. So 29 times the 500 shares I have is 14.5. When I add the two together, my total investment right now has actually went down by $1,000 compared to my original 67.5. So I need to show this as a journal entry at the end of the year when I own stock. I need to do a revalue. I need to revalue them. And this is a loss. I have a $1,000 loss, and we're going to call this the unrealized loss. And notice it's unrealized because no transaction really took place. I didn't really sell the stock. But if I had, I would have had a loss. And again, I'm reminding us that the unrealized losses don't even show up as part of net income. They're actually down below in something kind of even separate called other comprehensive income. And then the allowance to adjust the investment. So remember back up here, when our stocks are revalued, I'm going to use kind of like my accumulated depreciation account where it goes side by side with the original asset that I had, the equipment maybe. So I'm going to show here that my investment as an asset, if it's credited, that's going to be a loss. It's going to be a negative. So my asset went down by $1,000 in value. So if I was looking at the investment on my balance sheet, it really would have a net value of $66.5 instead of the $67.5 because of that $1,000 decline. Okay, now let's say we're into the second year and it's the end of May and I decide to go ahead and sell the stock. Stocks kept going up. My Toyota went back almost up to where I bought it for. I think that's probably going to be the highest it's going to get, so I decided to sell. So Toyota, sell for $55. I'm going to bring in $55,000 because I have 1,000 shares. $34 for Toyota. I almost got back up to the 35 that I bought it at. So 34 times 500, 17,000. So now, when I actually make a sale, a real sale, I'm going to bring in $72,000. Now, when we go back up here to my directions, when the stock is actually sold, two things we have to do. The first one is we need to pretend that this unrealized gain or loss that I have in the corresponding allowance account, we got to wipe them out, get them out of there and to zero. So let's do that first. So basically this transaction, since I only had it for a year, is going to be flipped. I'm going to get rid of the allowance account, bringing my investment back up to $67,000 and getting rid of that unrealized loss because now it's not even a loss. And then I need to show what it actually is, a realized gain. So I brought in cash of $72,000. These guys have been wiped back out. They're no longer even there. So I'm going to use my original value, the cost of $67.5, and compare that to what I brought in. And I brought in more than $67.5, so I have a gain in my sale of investment. And that's what this is here. And this is going to go on the income statement as part of the other comprehensive, as part of other gains and losses. But it is part of your net income because it is a actual transaction that took place. All right, so that's owning less than 20%. Let's now look at if you own between 20 and 50%. All right, so here's my little outlook on what we're going to do. When you purchase the original investment, instead of calling it the, back up here, when we called it the investment and available for sales securities, we're going to call this what it is. We're going to call it an equity method investment. You could call it investment equity method. Just kind of turn the words around. The equity method investment. Equity method means you own a solid portion of the company, in this case 20 to 50%, and that's telling the anybody looking at your financials that you could have significant influence over this company. So when the company has, when they issue and show their net income for the year, since you own a large portion of the company, you actually show on your books their income. But you only show the percentage of stock that you own. So if you own 25% of some company stock, you're actually going to show 25% of their revenue on your books, because it's like you made the money since you're such a large owner of that company. And that's what I have here. When that company makes money and has a net income, you're going to show it as an additional investment into that business. Because the better that company does, the better you're going to do because you're such a large owner. And then whatever percent that you own the stock, you're going to take that percent of their net income and call it your revenue. So it's a little weird. And then what's different than the available for sale as well is when dividends are paid. Since you are considered such a large owner of the company, no longer is this considered a dividend revenue to you. It's not like it's some outside source coming in. It's like you paying yourself. One company paying another company and you own both of them. So if the company that's paying the dividends pays you money, it's like you lost a little bit of ownership in that company. Because it's kind of like you taking money back out of that business. If you were looking at it from a individual standpoint, it would be like the owner taking a drawing out of the business. The owner's equity goes down. In comparison to if the owner puts money into the business, that's an increase in their capital. Increases the owner's equity. In this case, we're taking money back out of the business that we own. And then when selling stock, again, this is going to be different. This is done differently as well than the available for sale. When you sell the stock, you're going to base your gain or loss on what your running total is in the equity. So before with available for sale, we based it on our original cost. Now we're not going to do that. We're going to base it on what our running updated value is at the end of whenever we sell it. Okay, so let's put this into practice using what I have here. I purchased 30,000 of shares of Gatorade, which gives me a 35% ownership in the company. And those shares sell for $100 each. Okay, so when we purchase something and we own 20 to 50%, we're going to use this equity method investment account. Again, it's a long-term assets, just like equipment or land. So I'm going to debit this long-term asset account for $3 million. 30,000 times $100 a share is $3 million. And I pay the money. And then let's say nothing happens throughout the year, no dividends or anything, and Gatorade reports $500,000 in net income. Well, remember, we must record however much we own of the company. We've got to record their income as part of our revenue. And then the corresponding account, we're going to show an increased investment in our business. So if they record $500,000, I'm going to show 35% ownership. I'm going to I have 35% ownership, so I'm going to show 35% of this as revenue. And then the corresponding debit would be an increase in the investment in my business. So 35% of 500,000 is 175,000. Debiting that initial asset account. So the value in the company on my books has went from $3 million up to $3,175,000 now. And I've also shown as on my income statement some revenue, additional revenue than my normal business. Okay, so now in February of the second year here, the next year, Gatorade pays $200,000 in dividends out of the $500,000 net income they had. So remember, when dividends are paid, it's like paying yourself. Yeah, you're getting the money, but in return, you're getting money, but you're taking it out of the business's overall wealth. So I'm going to get, if they pay $200,000, I'm going to get 35% of that, because that's how much stock I own. So 35% of $200,000 is $70,000, and I'm going to show this as a credit, as a decrease in the value of my business, of what I own. So then if I was looking at the balance sheet, I'm going to have a running total, an updated ownership, and this is an actual number. I'm not going to deviate from this. This isn't a separate allowance account. This is the actual true value now, the $3,105,000 versus at the start of last year just $3 million. So in the by August 31 of the second year, I decide I want to sell 10% of the stock that I own in Gatorade, and I'm going to sell it for $320,000. Well, 10%, I'm going to take that based off of what the stock's currently worth. If I sell 10% of $3,105,000, that's me getting rid of 10% is $310,500, just moving the decimal place one time. And that's how you can easily do that real fast in your head. Just move the decimal from here to right here, and that's $310,500. So I got rid of some of my investment, $310,500, and I brought in cash of $320,000. Now I can show that I had a gain because an actual transaction took place here of $9,500. And that's going to go right on the income statement because it is I should put here, a realized gain on the sale of investment. Notice they didn't really do a revalue here based on what the stock's actually selling for. It's sure it's important, but it's not important to my accounting records. What's important is how much net income did the company that I own make, not what is the stock selling for. Okay, the last category is held to maturity. And again, this isn't necessarily for stocks because a lot of stocks don't necessarily have a maturity value, but items that are more debt related would have a maturity value. They're going to come due, or all payment will be due within a certain number of years. With a mortgage, that could easily be 30 years. But a lot of bonds are 5, 7, maybe 10 years. And bonds are basically a way to get large sums of money in a relatively quick fashion instead of taking out loans at a bank. You're going to have investors want to come buy some of your bonds. They're going to give you money to help build your business, and then in turn you're going to pay those bonds back with interest. Okay, so let's kind of give a little overview of bonds before we look at an example. First thing we do, just like what we did with the other two, as soon as we buy the bonds, we're going to debit this as an investment, and this one we're going to call, just kind of like the other ones, it's an investment, so it's a long-term asset held to maturity, investment in bonds. It's kind of a long name. Every company may call it a little bit different, but that's a good overview there. Determining bonds' initial cost. Okay, just bonds will usually have a face value on them. They'll say it's a $1,000 bond. You pay in a sense, you pay $1,000, we give you this bond that says in 5 years I'll give you $1,000 back. And in the meantime, I'll pay you some interest to help offset some of your costs and to make my bonds look attractive. Because nobody's going to want to buy a $1,000 bond and then get $1,000 back in 5 years. You're losing money in that way. You're not getting anything back on your return on your investment. So just because a bond says it sells for $1,000 doesn't really mean that it's going to sell for $1,000. It all depends on the interest rate. The interest rate that's on the bond versus what the market is actually paying at the time. Just because a bond says it's selling 5% doesn't mean that all bonds are selling 5%. That's just what that company thought would be a good set rate at that time. But if the market is currently paying 6%, they didn't guess very well. Because just because you decide that you want to sell bonds, you don't just start selling it the next day. You have to go through quite a process, and I'm not going to get into that here. But it might be 3 or 4, maybe 6 months down the road before you can actually sell them. And the interest rates in the market could definitely change, and what maybe happened in this example. So your bond sells for 5%. The market for any other bond sells for 6%. So who's going to want to buy your bond? Nobody wants to get less interest income. So to make your bond more attractive, you're going to have to sell your bond for less than what you have stated on there of $1,000. So yes, you're going to pay back $1,000 in 5 years, but that investor only has to pay you, say, $930 right now, and then you're going to give them interest, and then you're going to pay them back that extra $70 to get them up to $1,000 at the end of the 5th year. So in that way, I call that extra $70. If they only pay you $930 and the bond is really has a face value of $1,000, I call that hidden interest. And then eventually we're going to show that hidden interest being paid out little by little, just like what depreciation looks like with straight line. But then the other could be true as well. You could have your bond at 6%, the market's really only paying 5%. So then everybody in the world wants your bond that's paying the highest interest. And if that's the case, you can sell your bond for a premium. And so instead of your bond selling for $1,000, you're actually going to sell it for $1,060. So they're paying you more than what you're going to pay back in 5 years. They're paying you $1,060 now, and then you're going to pay them back only $1,000 in 5 years. But in return, you're paying them a higher interest than they would get elsewhere. So how do we find what the bond's selling for? There's 2 real ways. The first way is by far the easiest. If the book or any problems just give you a percent, they say we're selling the bond at 98% or just 98. That means 98% of the face value. So you would get 980. You would have to pay 980 if you were buying the bond, or 104 would be 104%. That difference, that $40 difference in this case, is considered hidden interest, going either way. You either have to show that you're paying more interest, like if you bought it for $980, or if you sold it, if you're the person actually selling the bond and you sold it for $980, you're paying an additional $20 in interest that I call hidden interest. That's my wording. And then if they don't give you this, they don't tell you the 98%, then we're going to use Excel to determine what the present value of that bond really is. And I show you in the screenshot below how to do that. It's also in the book. Remember, bonds, as I said, pay out interest. That's the only way that make bonds attractive for investors. And we're going to record this just like we would dividends. So we got the money, we get the cash. Or if it's at the end of the period and we need to update our books, we're going to show the interest is due to us, even though we haven't got it. And then interest revenue is our credit, just like dividend revenue. One of the last things we have to do is amortize our bond. And the amortize is this $20 difference, or amortize this $40 difference. because remember, we originally record our bond at cost. So the bond's going to show that I brought in $980, or I actually paid $980. So I'm going to have a bond investment of $980, credit cash of $980. But really, it's got to be $1,000. So eventually, I'm going to work this up and show revenue being earned every single time. Even though I'm not getting the money, I won't get the money until one time when the bond's paid back to me at $1,000. I won't get that extra 20 bucks, but I'm going to eventually show it little by little each year. So when that's the case, if the bond did sell for a discount, I paid less. I paid $980 instead of $1,000. Each time I have to do this, each time the interest is paid, I'm not only going to show that I received interest, but I'm going to show a small portion of that 20 bucks. So if interest is paid 2 times a year for 5 years, so that's 10 times that interest is paid over that 5-year bond life. So I'm going to divide up that 20 bucks into 10 equal installments and show that I got an extra $2 in revenue every single time I got interest. Even though they didn't pay me that $2 yet, they're going to pay it to me later. I'm going to add the 2 bucks to my bond investment. So now after the first time, it went from $980 and now I just debited it $2 more. So now the bond value is at $982. After 5 years of doing that, my bond value will be $1,000, and then the other company will pay me back the $1,000 that it shows that I should have worth in the bonds. It's kind of neat how that works. Okay, let's look at this example. So on October 1 of our first year, we purchased 7 bonds that pay 6%, and they're valued at $10,000 each. And so we're buying 7 of them. A $10,000 bond that pays 6% interest. And their bonds reach maturity in 5 years. The current market rate is 7%, and I'm going to compare that to what I sell them at for 6. That's telling me that I'm going to have to sell my bond at a discount. Nobody's going to want my bond that pays 6% when they can go somewhere else and get 7, unless I sell it for less than $10,000. And the bond pays semi-annual interest every April and October. Okay, so we're gonna walk through how we do this in Excel, and then I'll scroll down after a couple of these and update and show you the screenshot. So when you open up Excel, you're going to look for this little FX button in that formula, in that little bar where you can type things in. Well, the first thing you might do is just click on a cell, any cell, doesn't matter. And then click on this little FX button. And when you do, you'll have a little, something similar to this, but it won't be this. It won't look just like this. And it'll say, well, which function do you want to use? And you'll just want to type in, if it doesn't show up automatically as one of the first ones, because it is a common one, search for the PV, the present value item. So find the present value function. Okay, the first thing you come to says, well, what's the rate for your bond? The rate, we always state the rate at what the market is. That's one of the key things that people get confused on all the time. It's very easy to think, well, it's what my bond rate is. No, we want to use because this is telling me the present value of the bond using current market rate numbers. So the rate of my bond is, as it tells in the problem here, 7%. Now that's for a year. If my bonds pay semi-annual interest, then I got to get this interest, this percentage, into twice a year number instead of annual. So if it's twice a year, I just divide it by 2. So 3.5% is what my bond is paying. And then the next one is, basically says how many times are you paying interest. And if it's paying twice a year for 5 years, that's 10 times. The next thing is payment, and that's where we have to go back up to our bond. Our bond pays 6% per year on a $10,000 bond. Well, how much do they pay if it's only half a year? If it's only half a year, they only pay 3% at a time. So 3 and 3 gives me the 6 for the whole year. If you take 3% of $10,000, that's $300. So that's where I get this 300 from. And then the final thing is FV, that stands for the future value. What's your bond going to be worth at the end of the 5th year? And that's just the stated value. The bond is going to be worth, and I'm going to pay out $10,000. So I put that in. And then it calculates right here for us how much our bond is worth. Each bond, remember I told you, is going to sell for a discount because our percentage is lower. Each bond is going to sell for $9,584.17 rounded. But that's just if I sold one bond. So what I'm going to want to do is click OK on my Excel, have this number transferred into that actual cell workbook, and then multiply it by how many bonds am I actually selling. So I get the actual number, and I said I'm selling 7 of them. So how I got this number then, I want to take whatever this number is all the way out. I'm going to round it to 17 cents, but it's best to use the entire number. 95.8417 times 7 bonds, and that's how I get the 67,089.19. Now again, they used it when I did it in Excel, and this is how they'll want you to do it in the homework, is they'll want you to use this entire number, get your final answer, then round it to the nearest penny. So let me see what this comes out to be, maybe a couple pennies different. Oh, it came out good to the same number. So this is me, my initial long-term asset, just like with the stocks, the investment in the stocks, showing that I paid money for it. Now, semi-annual interest. Well, when the end of the year comes, 12/31, I need to show an adjusting entry. So that's my next step here. On 12/31, I show an adjusting entry that says, if I was paid interest at the end of only 3 months, how much would I have been paid? And then I would show, I'll go ahead and put it on here, and I'll only do it for 4/1 just to show the actual payment of dividends, because we would have gotten a payment again, and maybe I'll show it as well. Actual payment of dividends, remember that was $300. Let's go back up here. After only 3 months, if you think about the math formula, how to get interest, it's I equals PRT. If you want to think of it like that, interest equals principal, which was $10,000, times the rate, 6%. But then what's your time frame? And it's only a quarter of a year. So when I do this formula, the principal times what the bond's paying, 6%, times my rate of only a fourth of a year, I'm showing that interest is due $150 and I earn the money, interest revenue. Come 4/1, I'm actually receiving cash of $300. Part of that was earned last year and shown as an interest receivable, and the rest of it is interest earned this year. That's interest revenue for the year. And then if I go to 10/1, another payment, I did have a adjusting entry, actual payment of dividend, because they're going to pay me the same amount each 6 months, because that's how bonds work. They're going to pay me another $300. But this time, I didn't have any interest receivable. I didn't have any adjusting entries to make, so I'm just going to record interest revenue for the amount of $300. The last thing that I need to do, this should actually, I'm sorry, this is still part of the first year. This should go below. So back up here where I was calculating my adjusting entry of interest receivable and interest revenue, I also remember have to get rid of the discount. Remember, the bond actually is going to pay me back $10,000 at 7 apiece, so that's $70,000. But it's only recorded on my books right now at what I paid for, $67,000. So slowly, I need to get this number up to $70,000 and showing that that's extra revenue that I have earned. So what I need to do is get the difference. First off, I need to get the difference. How much am I going to have to get up to $70,000? So that's an extra, a little over $2,900. And I'm going to need to space that out evenly every single time interest is made, or whenever I have an adjusting entry that needs to be made. So if I've only had this bond for 3 months out of the 5 years, I need to do the corresponding math then. I need to show that if I was to break this amortization up over yearly and then cut it down half a year or whatever, there's many ways you could do this. So just the way that I showed is, if I was to break this up evenly like straight line depreciation, it would be, I need to show $582.16 every year added into my bond value, and then the other part going into revenue. But if instead of a yearly amount, I've only had it for a quarter of a year. So I need to take that $582 at a quarter. And that's $145 I need to add into my bond's value. So at the end of the year, my current bond would be current bond value would equal the original. Let's copy and paste it. 67. It's worth 67 plus. Now I just added in to its account an additional $145.54. So that's going to bring me to a grand total $67,234 and some change. So this is, I'm getting closer and closer, and by the end of the 5th year, this number will have hit 70,000. And now I can go ahead and do my actual payment of dividends into the 2nd year. So this is 12/31 current year. Should maybe put that 12/31 current year, and this would be 4/31 following year, or 2nd year. Okay. Last item we're going to look at is the time value of money. And the time value of money says that money today is definitely worth more than money tomorrow or money next year, however you want to think of it, because of interest. If you have money put away, you're going to begin to earn interest. And there's 2 different ways to tell how much interest you're going to earn. And you're either going to use you're either going to earn money on one lump sum, and you're going to say, I have $2,000 and I want to know what $2,000 is worth in 5 years. Or you're going to say, I'm going to put the same amount of money away every year at the same time, and that's called an annuity. So I'm going to put away $2,000 every year for the next 5 years. How much am I going to have at the end of 5 years? Versus the first example, I want to put $2,000 away one time. How much am I going to have in 5 years? And then the other one is putting $2,000 away every year for 5 years. How much am I going to have? What those examples were examples I just gave were future value. I know what I have right now. I have $2,000. I want to know, what is that lump sum worth after X number of months or years, in my case 5 years. So I'm going to know to use the future value of a dollar table. And when you get into your homework assignments or in the book has them laid out on the page, has some of the tables laid out for us, starting on page 452. You're just going to want to be careful on which table to use, because there's future value and there's present value. Present value says, I know that you're going to give me $3,000 in 3 years. How much is that worth today? You could just pay me today and we would be even. Because you wouldn't want to, if somebody's going to pay me $3,000 in 3 years, if they paid me $3,000 right now, that would be a great benefit to me. Because getting money today is better than getting it 3 years from now, if it's the same amount. So that person who owes me $3,000 in 3 years, they could pay me less, and I should be okay with that based on the interest that I could earn over that 3 years on that less amount to get me up to $3,000. So to know if you're going to use this present value of a dollar, we know that there's a lump sum due in the future sometime. And I want to know, with that future lump sum, what's it worth right now? Okay. Same with annuities. I want to know what $2,000 is worth at the end of the 5 years. Every year I have $2,000. Present value is kind of similar. I want to know, instead of somebody paying me $2,000 every year for 5 years, what could they pay me right now instead of $2,000 every year for the next 5 years, and I would be okay with it. So let's, to end the day here, let's look at a couple examples to see. So in my first example, how much is $7,000 to be received in 7 years? So I'm going to receive one lump sum payment 7 years from now, but if I was willing to take it right now, assuming there's I can invest the money at 6%, how much am I willing to take? Well, I would look up 7 as my actual periods, 6 is my interest rate, and I know that I'm going to use the present value of the dollar table. 1, because I'm using a lump sum. 2, because I want to know what it's worth right now. 7,000, and then I look up this number in the charts is 46.55. So instead of receiving 7,000 in 7 years, I should be okay with getting 46.55 right now. It's worth the same. My other example here is, how much are annual $7,000 payments for the next 7 years? So this one was just one lump sum, $7,000. This one, I'm due to receive $7,000 every year for the next 7 years. If they were to pay me off right now, and this is kind of like what the lottery does. You could get, if you win the lottery, say $10 million, they're going to pay you, and then they give you a number, this X amount over the next 20 years, and that equals out to be $10 million. Or they'll say, we're going to pay you one lump sum right now if you want it, and it's generally about half. Well, this is what they're doing. They're using this annuity type formula. They're saying, okay, instead of 7,000 every year for the next 7 years, we're going to use the present value of an annuity table, and we're going to assume, again, I think I did 6%. So 6%, and if you look up 6% in the present value of an annuity table, 5.582. So if they pay me $39,074 versus over the 7 years they would pay me $49,000, they're only going to pay me $39,000. I should be okay with that, assuming a 6% interest rate. Every one of the problems we did here corresponds with the items that are in your homework. So you should be able to go right in now and do most of your homework and get it all correct. I'm not going to have the time to go into it because we've already pretty much gone over the hour that I like to do for these lectures. I don't want them to be too long. So we're going to stop it here, and I'll see you next week for week 10.